huge drops in gold and silver. A chart of gold is looking like it wants to go to about $3,600. That is going to be a sweet spot in terms of if it drops down to this level. To me, it's fair value or it's undervalued. The next upside target should be around 8,000 to about 8,600 for gold. So $40 silver. But what it does, Jeremy, is it actually goes right back. It's the same with gold. Long term, it's a giant bull flag pattern pointing to much higher pricing. Is around 165, 175 an ounce if it starts to find traction. It's the same type of thing. It's generally emotions. People always say, oh, they're blaming it on money being manipulated and robots and systems. But when you go back and you look at all of these phases where sentiment gets so extreme like this, and we have these huge rips and drops in the market, it's typical price action. Hey, if the dollar breaks to the upside and breaks out of this multi-year kind of base, look out, because metals could get hit very hard. It also might mean the stock market and the economy actually might be starting to come to an end here, and we might start to see a big sell-off. Margin's going to always be a problem. Everybody's always over-leveraged. Everybody always buys a house just at the upside of their mortgage.
I mean, gold did break below that $4,000 last week for the first time, as I said, since November. Kind of clawed back this morning. It's right kind of testing that line down better than, I guess, 1.5% on the day. Now, again, you trade levels. You don't trade headlines. So give it to me straight here. I mean, is this line holding or breaking? And if it breaks, where does the chart actually say gold kind of goes? And how deep is that real downside?
Yeah, I mean, when we look at the chart of gold, there's no doubt the chart has had a lot of damage. When we zoom back on the daily chart, we really saw precious metals, obviously early this year, just go completely ballistic. It broke out of a bull flag chart pattern, and everyone really just chased it and drove it higher. If you weren't in precious metals by this point, you were the one driving this market up, piling in. And when we get into this euphoric phase, it creates these very sharp movements. And the big question is where is gold going to find support? And where is it going to find some traction? When we look at this chart, we've got a very significant level across where we're starting to break through right here. We've got these lows in gold. This is a very significant pivot point for gold right now. It is clinging on to breaking through this consolidation that we saw late last year. We had a spike low early in March. It had a bounce there a few weeks ago. And right now it is.
Gold slipping below a major support level matters far more than reassuring headlines about temporary rebounds. Chris Vermeulen notes that chart damage is already visible, but the larger warning is how emotional buying often creates the weakest foundations for a rally. Institutions typically reduce risk, while retail investors chase momentum after breakouts. Your portfolio is exposed if you're reacting emotionally instead of respecting market structure. Next, Chris Vermeulen reveals why the strongest support zone could become the market's biggest psychological trap.
If it lets loose here, we're going to see it unwind fairly quickly. And the chart pattern for gold, I mean, depends how you look at it. I want lower pricing. I think it's great. It's good long-term price action. It means gold will be stronger in the long run. Short, people holding on to it have to sweat it out right now. But I mean, if you're a long-term investor, it really doesn't matter, because I think gold will end up going a whole lot higher. So just based on Fibonacci theory, which is based on kind of a power in the universe that more or less tells you based on one movement and its reaction, it shows you where the next two likely movements are to be. So we had the initial sell-off in gold. It bounced up. We've come down to this 618 level. Now, this is called the golden ratio. This is the most powerful kind of value early in the universe. If you pause and bounce at the 618, which we have, we almost always see a commodity or asset continue to move to the 100% measured move, which is what the 1 stands for. So right now, the chart of gold is looking like it wants to go to about $3,600. That is going to be a sweet spot in terms of if it drops down to this level. To me, it's fair value or it's undervalued. I think it's a great long-term investment. As you mentioned, we exited out of gold up here just above 5,000. And so we're looking to reload down from this target.
The biggest opportunity for long-term investors often arrives when confidence disappears, not when optimism peaks. According to Chris Vermeulen, a decline toward $3,600 would strengthen the long-term bull case instead of destroying it, challenging the popular belief that every correction signals failure. Wall Street rarely celebrates cheaper accumulation prices because fear keeps capital frozen. patient investors understand that valuation improves while headlines grow darker. Next, Chris Vermeulen exposes why today's panic could be laying the foundation for tomorrow's strongest rally.
And eventually, when gold gets its traction here, the next upside target should be around 8,000 to about 8,600 for gold. So there's lots of upside potential. There's a nice double from pretty much where we are right now, but there is still potential downside in gold. And the problem here, and the reason why I move in and out of specific assets, is because we don't know how long something could take to go up to those targets, right? We have seen gold and silver take 5, 10, 14 years to, or even longer in some cases, to get back to previous highs. And so I like to move my money into an asset that is generating return while that commodity is figuring itself out. So that's the sweet spot for gold, is about 3,600. If it hits that level, then it's like definitely start to accumulate physical metals again and get ready for the next move higher.
Get ready for a little bit of a rip. You know what? It's interesting, your point there, because one thing people keep asking, these moves they've gotten violent. I mean, gold gapping around, big reversals inside of a single day. I was reading this morning some of these positions in the ETF flows and what have you. I mean, how much of this, or that, I guess, is algorithms and kind of big money program trading shoving the price around? And if it is, I mean, what's your advice for a regular person keeping from getting whipsawed by it?
Violent swings don't necessarily signal broken markets. They often expose broken investor discipline. What Chris Vermeulen is highlighting is that time can be just as costly as price when capital sits trapped in stagnant assets for years. Institutional investors constantly evaluate opportunity cost, while many retail investors remain emotionally attached to one position. Preserving wealth sometimes means patiently waiting instead of constantly defending yesterday's trade. Next, Chris Vermeulen reveals why volatility itself may be misleading investors about what's really driving precious metals.
Yeah, I think it all depends on how you look at it. Like, yeah, sure, there's algos and there's systems out there, but the precious metal space is small. It really, the price action that we have seen, like when we see these huge drops in gold and silver and miners and these big pops and drops, to be honest, Jeremy, it's like, it's the exact same price action we've seen for the almost 30 years that I've been trading and investing. It's the same type of thing. It's generally emotions. People always say, oh, they're blaming it on, money being manipulated and robots and systems. But when you go back and you look at all of these phases where sentiment gets so extreme like this, and we have these huge, rips and drops in the market, it's typical price action. It's really the emotional people who are blaming it on the system are actually the ones creating the waves of massive buying and massive selling that creates the pops and drops in a lot of cases. So my whole thing is just to understand volatility and price action like we see in gold and silver and even the stock market right now. It really is just how it's kind of almost always been. There's always going to be some manipulation. There's nothing we can do about it. You just have to have a strategy and identify when we're in a high volatility state like we are now. It's just going to happen, right? And you just have to work that into your risk. And a lot of people they trade and invest, but they don't focus on risk. And it's all about managing your positions in your portfolio.
Every major correction looks manipulated while it's unfolding. Yet history often tells a far less comforting story. Chris Vermeulen's argument suggests that investor psychology has fueled many of the market's biggest collapses long before algorithms became today's convenient scapegoat. Blaming unseen forces can distract from poor risk management and emotional decision-making when volatility accelerates. Successful investors prepare for turbulence instead of searching for someone to blame after losses appear. Next, Chris Vermeulen exposes the overlooked mistake that quietly destroys more portfolios than market manipulation ever has.
Like, technical analysis is one thing. It helps you get an idea of where price should go, but it doesn't tell you how to trade. You have to understand how much should you put at risk? How long could this asset be dormant? Do I want to have my money stuck in it if it's not moving for the next year and a half or 2 years? So you really just have to kind of brush it off and be like, it's part of the game. There's going to be some that might swing you and stop you out here and there, but I mean, that's just the reality of you play with the markets. You got to deal with what it gives us.
Yeah, and of course they've been interesting. I'll tell you from this perspective, covering them. Obviously, a lot of volatility. I mean, you were on the show back in April, and you don't shy away from making calls. So let's just look at a couple of those to play out, just because that kind of tells us how you actually work in this market. I mean, you nailed what a few that plenty of people have kind of missed. I mean, you said that the dollar would break out and that rates would kind of stay higher. Both of those things happened. I mean, the trickier one for a trader style is you wanted to kind of buy gold back lower, around $3,400, $3,500. I guess we're watching a little bit of that pullback now. You said maybe 3,600, you'd come back into it. So, I mean, this isn't about a number being right or wrong. It's about the discipline.
Being directionally correct means little if poor execution still damages your returns. This is where Chris Vermeulen's thesis shifts from forecasting prices to protecting capital through disciplined positioning rather than constant prediction. Professional money managers survive because they respect risk long before they celebrate gains, while many retail investors focus only on upside targets. Wealth compounds through consistency, not perfect calls. Next, Chris Vermeulen reveals why waiting for confirmation can outperform trying to buy every apparent bargain.
When you wait for a setup, and maybe it takes a little longer to show up, I mean, how do you kind of handle sitting out while the market runs, and how should someone at home kind of handle the same problem?
Well, I mean, it's difficult. I mean, it really comes down to if you have a strategy and rules to follow and you have the discipline to follow it, that's the problem, right? People just want to be active. They don't have the discipline to sit on their hands. And so we are sitting on our hands waiting for gold. I've owned gold and silver for a very long time, physical metals. And I don't have any. I feel very naked and exposed because obviously anybody who's into precious metals knows the risks and why we should have precious metals. But overall, I mean, I think you just have to have the discipline to sit on your hands and wait for that opportunity. We've seen gold and silver trade sideways for a decade plus, many, many times. In fact, it's been a lot longer, a couple decades if you go further back in time. It's a long time to hold something that doesn't do you any justice, right? Yeah. And so it just comes down to that strategy and understanding you have to have faith. I don't really care. Obviously, I'd like to buy gold at a lower price. What I don't want to waste is time. I want my money working for me. So if gold and silver just turned around here and started to go higher, Jeremy, and we get a new buy signal saying, hey, the metals are starting the next leg.
Doing nothing can sometimes be the most profitable decision an investor makes, even though it feels uncomfortable. Chris Vermeulen notes that discipline isn't about predicting every move, but refusing to commit capital before probabilities shift decisively in your favor. Markets constantly reward patience, while emotional urgency quietly transfers wealth from impatient participants to disciplined ones. Missing part of a rally often costs far less than sitting through years of dead money. Next, Chris Vermeulen reveals why buying later can actually produce stronger long-term returns than buying first.
I'll just buy in at a higher price, but I don't want to buy into something until the train is leaving the station in the direction I want. And the best analogy is really, it's like if you go to another country, you don't speak the language, you can't read the signs, but you're at the train station and it could go either way. The only thing you can really do is wait for it to start to leave the station and be like, oh my God, that's going in the direction I want to go. And you hop on it. And so I would rather jump into something even at a higher price and just catch the big move and have kind of instant gratification and growth than just sit on it and it goes the wrong way for a while. And then it's got to turn around and it's got to go back on the tracks and go the other way. So the biggest thing for me is protect our time, protect our capital, and make sure if our money's at work, whatever we put it to work in, it's got to meet rules in our strategy, our criteria to put our money at risk.
That's a good point. I mean, for someone who owns physical gold as insurance, not as a trade, some of these sell signals might not apply to them. When you're talking to traders specifically, I mean, are you seeing other frothy areas? I got to ask you about silver. I mean, it got even hit harder today. I think it's down about 2% harder than gold. It's more volatile of the two. I mean,
the market doesn't reward being first nearly as often as it rewards being right. According to Chris Vermeulen, waiting for confirmed momentum may mean paying a higher price, but it dramatically reduces the odds of getting trapped in prolonged declines. Institutions frequently sacrifice perfect entries to improve probability, while retail investors obsess over buying the exact bottom. Protecting both time and capital usually beats chasing bargains that never recover. Next, Chris Vermeulen exposes why silver's sharper swings could be sending an even stronger warning than gold.
Is there a chart that you're watching on silver right now? And do you got to hold at a certain price here? I mean, it's been extremely volatile, Chris.
Yeah, silver is really volatile. It has a very significant support level. It has been trying to hold through this $64, $65. It has clearly broken down. If you look at metals, they've been bouncing across support, and they're starting to break down. And as you brought up a few moments ago, Jeremy, we look at the U.S. dollar. The U.S. dollar has done the opposite. We've been looking for the dollar, saying, hey, if the dollar breaks to the upside and breaks out of this multi-year kind of base, look out, because metals could get hit very hard. It also might mean the stock market and the economy actually might be starting to come to an end here, and we might start to see a big sell-off. There's a lot of upside potential. The chart for the dollar is actually pointing to a rally up to about 109. That's a 9% move in it, which is going to hurt precious metals. And if we go back and look at silver, the chart of silver, it's already hit some of its measured moves. If we take a look at this initial drop, it had its initial drop down here, and then it had its bounce. If we kind of carry it over to where it is, we can see that it hit the 618. It had another big bounce up. It's kind of hit the 618 again, and it is heading towards that 100% measured move. Now,
markets climbed while the dollar strengthened, yet precious metals weakened, a divergence investors ignore at their own risk. What Chris Vermeulen is highlighting is that a sustained dollar index rally toward 109 could pressure both gold and silver far more than optimistic forecasts currently acknowledge. Large institutions monitor currency trends because they often lead commodity moves months in advance. Savers focus only on metal prices may miss the macro force driving them lower. Next, Chris Vermeulen reveals the overlooked price target that could reset silver before its next major bull run.
This is a long way down from where we are. This is $40 silver. But what it does, Jeremy, is it actually goes right back. It's the same with gold. It goes right back to the point where people late to the game who bought into the euphoric phase and just drove the markets up and bought on emotions and FOMO, and they just needed to get into it. All of those people who chase returns are chasing performance and trading on emotions. The market loves to try to put them under pressure and try and get them back out before they go. And so that is exactly what gold and silver are doing. Both charts point to the exact point where everybody went into a euphoric phase and just they had to buy more gold or silver or buy it for their first time. And so silver right now is pointing to still a very sharp correction. We've got the dollar breaking out. A lot of things are aligning for gold and silver to have this cleansing event, which again, it's a cleansing event. It's an opportunity to add more. It's also, when you zoom back on the chart, long term, it's a giant bull flag pattern pointing to much higher pricing. The upside target for silver is around 165, 175 an ounce if it starts to find traction here. So there's lots of potential, and it just comes down to, do you want to, move in and out of it? Everybody has their own way of investing in metals, right? Some long-term insurance is what I kind of do, but I also bring in a little bit of the
investors who panic near bottoms are often the same ones who bought enthusiastically near the highs. Chris Vermeulen's argument suggests that deep corrections are designed to exhaust emotional buyers before the next sustainable advance begins. History repeatedly shows institutions accumulating during fear, while headlines convince the public that the trend is permanently broken. Long-term wealth is usually built through disciplined accumulation rather than emotional reaction. Next, Chris Vermeulen unravels why selling into strength can actually strengthen a long-term precious metal strategy.
I want to sell it when it's kind of overdone. Like we sold silver at 111, and I'm looking to pick it up, somewhere down into this zone and accumulate at a lower level. So it's just the way that I trade. I look at it as an insurance, but I trade my insurance plan.
Yeah, makes sense. Hey, Chris, I mean, if you're full of cash right now, I mean, that's what you're kind of looking at for some liquidity, some dry powder, then the next question is not just what you avoided, it's kind of what you're stocking. So, I mean, cash is a position, but it can't be the whole plan forever. Is there any sectors on your watch list right now? I mean, are you looking at defensive sectors like utilities or staples or healthcare, anything other, maybe it's dollar or bonds, something outside of equities entirely?
Yeah, well, the main thing we're looking at, obviously, when we move to cash is a position. It's much better to earn 3-4% in cash than to watch your account fall 20 or 50%, right? So cash is a very good position, but as you're right, you do want our money to work. When we don't have a signal, we in the equities market, we look elsewhere. Bonds aren't there yet. Bonds are still trying to find a bottom. The US dollar is actually looking very primed and ready. It has broken out of a big base. It's having a little bit of a pullback over the past couple of sessions. When or if this stock market actually trend comes to an end, potentially even this week or next week, we may move to the dollar, buy a dollar index ETF.
Cash quietly outperforms risky assets whenever avoiding losses becomes more important than chasing gains. This is where Chris Vermeulen's thesis shifts from precious metals toward capital preservation, emphasizing that liquidity creates flexibility when markets become unstable. Many investors underestimate how powerful a stable cash position can be during broad corrections, especially while waiting for higher probability opportunities. Sometimes the safest move is also the smartest investment decision.
So as the dollar goes up in value, our account can go up in value. And we actually did this and saw this in 2022. The stock market fell 25%. The US dollar ETF rallied about 18%. The dollar does tend to have an inverse relationship. If the economy and stock market's falling apart, the dollar tends to rally, and it's really low volatility, which is nice. The biggest pullback in the dollar for that whole year was less than 4%, and it moved 18% overall. So it's a low volatility, high probability play. It's very comfortable. And a lot of people don't like cash. They don't want to, especially if you're American, you might not want to hold a US dollar ETF. You're like, I'm already in American dollars. But it is an opportunity. It's a very good opportunity to make money. And people don't look at cash or a currency in a lot of cases as a position. They want stocks or sectors or a commodity. But sometimes the best spot is, out of all of those.
Yeah, well said. Interesting time watching oil, kind of come down on this with inflation as well. I got to ask you just quickly at the end here. I mean, on margins, have you been fearful of some of these margin calls, this liquidity side, people using gold, kind of that first liquid one to get out?
Margin's going to always be a problem. Everybody's always over leveraged, right? Everybody always buys a house just at the upside of their mortgage. Everybody always puts on a big enough position just that they're riding the edge of margin calls. So, I mean, it's just nature of people, right?
The asset investors complain about most often can quietly become the strongest performer during periods of financial stress. Chris Vermeulen notes that the US dollar has historically appreciated while stocks weakened, yet many investors dismiss currency exposure because it lacks the excitement of commodities or equities. Institutions prioritize preserving purchasing power before pursuing aggressive returns. Ignoring defensive assets can quietly erode long-term wealth when markets reverse. Next, Chris Vermeulen exposes why excessive leverage, not falling prices, usually triggers the most destructive market declines.
Everybody wants to make as much as they can. There's going to be, eventually when the market starts to sell off, there's going to be very strong margin calls. I mean, I think we're seeing some huge margin calls in Bitcoin and some of those other companies and strategies based around it. As precious metals start to break down even more, we're probably going to start to see a flood of margin calls in that space. I think a lot of people are clinging on, hoping gold and silver find a bottom. In fact, as I was talking about the breakdown last week in precious metals, I made a comment publicly, and the amount of people saying, this is support, I'm buying, this is the bottom. I'm like, oh no, here we go. This is typically when the general public react very sharply against something that I say. It's usually, probably going to come to fruition because the masses are all thinking the same thing and they usually get caught on the wrong side. So margin calls are going to be a massive problem. As we talked about, the complex for precious metals is very small. When the selling starts, they just bleed out. Silver drops extremely fast. Yeah. But again, long term, it's an opportunity. So I'm not concerned about it overall.
Yeah, well, we had that big run up in gold too. We had you on, and you kind of had more of a bearish kind of sentiment than some of the others, and you got those comments too. But here we are watching this correction.
The real danger isn't falling prices. It's forced selling by investors who borrowed too aggressively to survive normal volatility. According to Chris Vermeulen, widespread margin calls could accelerate declines well beyond what fundamentals alone would justify, creating exactly the kind of panic institutions often prepare to exploit. Retail investors tend to mistake emotional capitulation for permanent collapse, while disciplined capital views it as future opportunity. The biggest wealth transfers usually happen during these emotionally charged liquidation phases,